We've got Scott Forehand in studio with us from the Forehand Agency, joined also by Jonathan Daly. Welcome back to the Mighty 790, Mr. Scott Forehand.
Is that General Lee? General Lee Foster?
It's me.
In the studio.
It's me.
Right on.
How you doing, man?
I'm fantastic. The fact that I'm here with my good friend General Lee Foster and the incomparable Jonathan Daly. There should be like claps and applause now that Jonathan Daly's here on stage. There you go. There you go.
The legend.
Right on. He is a legend, actually.
You two gentlemen looking sharp today?
I think we both took showers this week. Yeah, this is a shower week.
That's a change for you, right?
It is, yeah. I usually, it's my wife is going to kill me. It's usually once a week, whether I need to or not, is the joke. But, it is what it is. So that's what they make. Never mind. Okay. Way too many jokes there that really shouldn't be said on this show. Right on. So, Jonathan, welcome to the studio, man. And thanks for making the drive down here.
Yeah, absolutely. Thanks for having me. General Lee, it's always a pleasure.
Came from Richmond, right?
Yeah.
Richmond,
yeah,
nice.
Yeah. So I can tune in. Usually do still go internet because I'm usually outside wrangling the kids. But happy to be here. Happy to be here with you, Scott. Not sure the listeners know what a treat it is to get to hear Scott talk about finance. So I'm along for the ride.
A treat.
It's a treat.
Yeah, treat. Okay, just like those Jelly Bellies that you don't want to eat. That kind of a treat. The garbage flavor.
More like that family vacation that you earned. That type of treat.
That type of treat.
Right. So, Dally, I can't remember. How long have you been with us now?
It's been 5 years next month.
5 years. So you've been running our Richmond office for 5 years and kicking butt at it.
Yeah.
And it's awesome, man. So I'm so glad you made the trip down, and we got a chance to hear some Dally wisdom, as I like to say. We're going to hear in just a few minutes. And if you ended up ever coming into our organization, you're going to get an opportunity to hear Mr. Dally. Every Wednesday morning at 9:30 a.m. we have a meeting that he runs. It's phenomenal, and it's certainly something that's a significantly beneficial component to our weekly schedule. So, as we do, typically we run these shows and we start in segments. First off, we start talking about some market action and charts and things like that, and then things that are happening and impacting the world of finance. And then we'll move into some of our traditional conversations about different types of retirement programs that are out there, why people would use one versus the other, what makes sense, what doesn't make sense. And then we'll, if we do, it is a live show, so if anybody wants to call in, we'll take calls and try to field questions if we can. Certainly can't give significant financial advice over the phone. There's a lot more to it than just say, yeah, go buy XYZ. Can't do that. But we can talk about your situation and maybe recommend a vehicle for you maybe, and probably would move into another conversation a little bit deeper later on. So first thing I want to do, I want to talk about the stock market. Everybody's aware yesterday we had the S&P and NASDAQ both record new highs, forever highs, which is great. It's just a day, folks. So it's just a day. So when they move up like that, that's great. The people that are in the S&P have some potential gains that they could be taking off the table, which I suspect next week you're going to see that happen. And both the NASDAQ and the S&P are going to be dropping some as people take profits off the table. But when I look at the markets, I try to look at the key cornerstones of what drives the market. And what drives the market, one of the major components of market movers is housing. And there's some interesting news about housing that has, if you're paying attention, and I do, if you're paying attention, then this is something. It's not going to tell you what's going to happen in the future. It's not a crystal ball, but it is something that has a it can give you some guidance. So where we are right now, what's recently happened, the housing prices, home prices, they go up over time. The average increase in housing prices over time is about 3%, maybe a little bit more, depending on what region of the country you live in. And it usually keeps pace with inflation, which is why real estate is in some cases a good hedge against inflation. And having real estate, especially if it's an income producing property, like a rental property or something along those lines, or an Airbnb, that it's even better. It's an investment, and you're not losing the underlying value of the investment because it's gaining in price with the speed or same speed that that inflation is raising. But when we look at that rate, when the rate drops, it causes some concern. And so what we've seen now is that home prices are rising at the slowest pace since the summer of 2023. So I'm not saying we're seeing a contraction in the market value, but we are seeing a reduction in the rate that the housing market is increasing in value. So for people that are out there that are thinking that their home is their, I just ran into a client last night where the client has a couple of properties, one of which is essentially a rental property, even though it's a second home. But those two pieces of property are not raising in value as fast as they would anticipate. So being able to have that as a cornerstone of that individual's retirement plan is, in this particular instance, probably a mistake. It should be part of the retirement plan, but it should not be the retirement plan. And that's kind of where that person is. And what to make that a little bit more evident, one of the other components that we look at for housing is housing starts. So you have people that buy houses, then you have people that build houses, and then you have investors that invest in the commercial side, which is a different beast. But in the case of housing starts, we're talking about not commercial property. We're talking about single-family dwellings that are being started, and it has dropped 10% for May over May, from May of 2024 to May of 2025. The number of housing starts dropped 10%. That's not good. That's something that should be a little bell should be going off in the back of your head. To put this in perspective, this has been the weakest May since COVID. Okay, so COVID, everything got reset, and we started moving forward with a lot of money that was injected into the economy, and that kind of restarted our economy a little bit. And this is the weakest it's been right now since May. You got any comment on that, Mr. Dally?
I said earlier, Scott, I just love listening to you talk for a couple of reasons, because for me, I'm a sports guy, and I'm going to try to break down what you said using a sports analogy.
Jonathan Dally, professional quarterback.
Retired.
So,
what you're telling me is that, you have this record high, all-time high in the S&P,
yep.
And everybody's celebrating it. And you
yep.
turn on the TV, you got talking heads throwing their hands up. It's a big day. I've even seen confetti fall. And when you look at the background, it's like, your team scored right before halftime. You're really happy. You're up. Everybody's celebrating, but your starting quarterback just got injured. And your defense is down. So when you're looking at the actual indicators in the market, you're looking at housing starts. You're looking at all of the background. It's like watching Tony Romo call a game. He's calling it how he sees it, and he's giving you the juice to know that the second half might not be as good as the first half. And that's the important thing when you're connecting with a professional, is finding somebody that knows how to call the game. You're not just looking at the scoreboard. You're looking at the indicators that are going to project what the next season, right?
Yeah.
As we approach this earnings season, it's easy to celebrate. It's easy to celebrate records. It's easy
yep.
to get our hands up in the air. But like most of our clients, like you'd mentioned, their wealth is in their real
yep.
estate. It's tucked into that rental property.
Yep.
And there's a huge fear of missing out. You have, we talked before we went live, what happens if the Fed cuts rates? Well, you have a lot of people who are going to jump at chomping at the bit, waiting to be a part
yeah.
of this huge celebration. They want confetti to fall on them. And oftentimes you have irrational decisions happen where, you're pulling money out of your real estate because you think it needs to be in the market, just to know that, you're listening to the wrong commentator on TV. So when I look at all of it and I you do your background due diligence to make sure that, you're not over celebrating. It's never as good as it seems. It's never as bad as it seems. You have to find that even keel, level head financial professor, if you will, Mr. Scott Forehand, everybody, you want to make sure that you don't have all your eggs in one basket, obviously, but you're doing the best by your eggs to make sure that they can hatch later. So it's a pleasure being here. Thanks for having me. And yeah, I like looking at all the big picture. Like you mentioned, we don't give specific financial advice because there's too many variables to control. We want to know the whole picture. We want to know what's going on with you. We want to know, where your FOMO comes from. If you're looking at the market thinking I need to be in the market, or a picture, where is your wealth? Where do you want to build it? What's your legacy? Who do you want to pass it to? Who do you want your wealth to pass to, and who do you want them to pass their wealth to? Right. So looking at the bigger picture is always fun for me because you can put together a game plan that could really knock it out of the park. Yeah.
And, as you just said something that's really important, and this is what especially novice investors are going to fall victim to a lot of times. FOMO, fear of missing out. And if you're reading it and you're seeing it in the news, or you're seeing it on a financial bulletin or whatever, that happened 2 days ago. The time to capitalize on whatever that thing was 2 days ago, not today. So that's why you can't just look at the rah-rah stuff and the, oh no, the sky is falling stuff. You got to take into consideration everything, and the things that we look at are not things that are going to make a splash for 30 seconds, like Friday's goals, or Friday's achievements. It's the other stuff. It's what's really happening behind the economy. And to continue down that housing conversation, we are seeing some retraction in market value. And we're seeing retraction in market value in places that maybe you wouldn't expect. So we've certainly seen reduction in the New York market, the California market, and there's obvious reasons why there's an exodus happening in those states right now. We're seeing a reduction in the Colorado market, lowering of house values in Colorado. Again, same reason. There's a logical reason why that's happening. But the most surprising thing for me is that we're seeing a reduction in the Florida market. And the Florida market year over year has seen a 1.8% average reduction in house value. And I was looking at, and that number gets exacerbated as you move up in price. So, for example, if your home is over $1 million, you didn't see a $1.8 million reduction in value. You probably saw as much as a 20% reduction in value. And then if you've got a lower range property, 100 to 200, we probably didn't see any reduction in value because there's still a lot of market value just in the fact of the price point that it's at. But on average, when we start looking at Florida, of all places, should not be seeing a reduction in home value, especially with the exodus that's happening along the eastern seaboard and up north towards southern states. The fact that they don't have any state income tax, the fact that they have a very well-respected governor and leadership in the state, it's something that you would think that Florida, if any place, would be seeing a significant increase in home values, and it's just not there. And that is one of the three bells that I have going off in my head right now. The fact that we've seen a reduction in the new housing starts, 10%, that's significant. The fact that we've slowed the value of housing has slowed. The raising of values has slowed to the lowest pace since 2023. That's significant. And then the fact that we're seeing reduction in home values in states where we shouldn't see a reduction. So there's always more pieces to the puzzle. But for me, there's three primary drivers of the U.S. market, and I'm not concerned with the European markets, although we are intertwined to a degree, and we'll talk about that in a minute. But the current situation with the housing is what I think is a significant driver, because other than the emotion, because people making decisions to buy and sell with emotion is a mistake, and it's always a mistake, and it's always what happens. The market is an emotion-driven entity. It's an emotional beast, and if you're going to do it and you're going to be in that space, you need to make sure you can control your emotions, or you need to hire a professional to do it for you, because they're not going to make the emotional decision. And and jump in just because it's hot and jump out just because somebody said the sky was falling. What do you think about that one, John?
Yeah, I love it because you mentioned that these decisions are, you're either making a logical decision or an emotional decision, and big money is in almost every industry a gamble, right? If you're thinking banks, if you're thinking the insurance side, it's risk, reward, and it's a numbers game. And if you're acting emotionally, you're that person at the sports book pressing your bet when your team scores before half and not looking at all the facts. Yeah, exactly. You want that person in your corner that can overanalyze. I just wrote down on my notes, average, above average, and exceptional. If you're going to a professional and find a financial professional that's average, they're going to watch the news and they're going to echo what they hear. If you go to somebody who's above average, they're going to do a little digging and reading between the lines. If you want somebody who's exceptional, they're going to look at housing markets in other states as key indicators for what's happening globally. And that's not even to mention all the talks about the tariffs and the U.S. economy, and I'm sure we'll go down that road. But when you look at it as a global scale, because we do in our business, we do look at global markets, lower volatility, but there's global records going off everywhere. So if you look around the world and everybody's winning, of course the U.S. economy is going to get that FOMO and press their bet, and there's a lot of emotion running true in the U.S. market right now. And I was just watching, the closing bell on Friday, and you for every 4 people that is raising their hands and having that confetti drop, as I said earlier, you have that one person who's trying to take their profits off the table because they know they're looking at other markets, they're looking at and if you can read between the lines, if you're that individual out there that just goes with your gut and makes that emotional decision, I pray that you're looking and reading between the lines. Look at these talking heads. Look at the ones that are, sweating out of their suit and swallowing deep and telling you to take the profits off the table because they're trying to scream that it's a false indicator, and you need to have somebody in your corner that could recognize that. Yeah,
and unfortunately for those guys that are saying that stuff, their jobs can actually be at risk because if they're not towing the line of the network, then they're probably not going to get their contract renewed. I don't like to give all bad news. I always like to have at least one shining positive thing. And here's the shining positive thing about the housing market. If you dig down deep and you try to figure out what's causing this, the knee-jerk reaction is that the reason why people aren't buying homes is because the mortgage rates are too high. And historically, we're not anywhere near where it's been. We're about right in the middle of where it's been over time, and this is actually not normal. This is abnormal. This is normal. So if you get down into it, the consensus is that what's happening is not related to mortgage rates. It's related to economic uncertainty, and that's something you just touched on, Jonathan. With BRICS, which we'll talk about in just a second, and with the tariff situation, and with the war, not war, ceasefire, re-war, all that stuff that's happening, and even with Iran now, and they're threatening to close the Strait of Hormuz, which would be economic suicide for them, and it really anger their biggest buying partner, which is China. So I'm all for it. Close the Strait of Hormuz, but so all that stuff when it comes out, there's so much noise, you don't know what to listen to. And unfortunately, the majority of our public, what they usually end up listening to is the loudest voice. And almost always the loudest voice isn't the right voice to listen to. And that's something you just said. The one guy in the back room quietly taking money off the table, he's the one. And if there's a movie that came out called The Big Short a couple of years ago, with Christian Bale as the lead, and that was the mortgage, the subprime lending bubble that he called and was right, and he shorted it and made a ton of money doing it, and basically had a lot of big brokerage houses up in New York over a barrel because he had big short contracts with them and they had to pay it. So that's
unfortunately for the general public, they waited years to see that movie. If they had seen it in real time, they could have made some profits the same. So to that point of having somebody in your corner that's going to do their due diligence and do the digging and really look at your specific plan and get you out of that emotional state of things are sunshine and rainbows or it's
Right.
all doom and gloom. You got to operate somewhere even keel. Look at the numbers, look at the logic, and make moves accordingly.
Right. So now we just want to dive a little bit. We started a segment a couple of months ago. We had some of my clients were asking information about crypto, and I'm not giving any advice on crypto right now. This is just anecdotal information. Okay, so just take it as information. I'm not telling you to buy or sell. All right. So we've seen some moves. We've seen some pretty good moves in the main cryptocurrencies that we track: Bitcoin, XRP, Doge, Solana, Ethereum, and what we're looking at right now is we have a ceiling and we have a floor. And the floor is about, at this point, you can probably safely reset the floor at about 70,000 for Bitcoin, and you can set the ceiling at its last high, which was 109. And so what we're looking at is pushing through and then establishing a new floor. I don't know when that's going to happen. It probably will happen. I don't know if it's going to be near term or long term, but what I can say is that the conditions for a rise above and support beyond, it's here. It's there now. And we've got some key indicators that if we look back in time, and again, this is, hindsight's 2020, but past performance does not dictate future performance. Okay, so take this with a grain of salt, folks. So there's a couple of reasons why I say Bitcoin's in a good position and XRP are in good positions to have fairly significant growth fairly rapidly over the course of the next 6-12 months. Here's the first reason. Capital liquidity. All right, so if you look at what's happening with the U.S. Fed reserves, the European Central Bank, and the Bank of Japan, all three have worked to gain to increase the number of assets that they had, which means if you've got more money, more capital, more assets that can be turned into liquid or are already liquid, then the availability of money spurs the economy, and that's what's happening with those three things. The first thing, that's the first part of this. The last time this happened, when all three banks were increasing their assets, again, we have to go back to COVID to look at that. That was from March of 2020 through April of 2021. We saw this increase in the amount of assets available. And what that did to Bitcoin back then, in that, 11-month span, it increased the value of Bitcoin over 500%. And what it did to XRP in that same time period, it increased the value of XRP 483%. Let me say this one more time. I am not advising you to go buy Bitcoin or XRP. I'm just reporting the facts, okay? So that's a significant, for me, that's a significant reason why if I were going to jump into Bitcoin or buy more Bitcoin, that might be a good enough reason for me to do it. Next, there's 5 parts to this of why I think these two coins, these two crypto currencies are going to have some significant gain. Next, the Fed. There has not been, and there is not Fed rate cut. That being said, I'm still convinced there's going to be a rate cut this year. And when that happens, it's going to spur the economy. Unfortunately, I think a lot of people are going to give that as a signal that they should go out and get mortgages. The Fed cutting the rates doesn't have anything to do with mortgage rates, just FYI, okay? So that's going to help. Third, and this is something that's really counterintuitive. If you think about Bitcoin and how people buy cryptocurrency, they're translating some kind of equity, whether it's fiat currency like the US dollar or something else, they're translating that into a number or proportional amount of crypto coin, whatever the coin they're buying. That is good for everybody else in the world when the US dollar is weaker. And right now, the US dollar has seen about an 8% drop in value on a national level, on an international level over the course of the last 6 months. So that is meaning that the rest of the world can purchase cryptocurrency cheaper than we can. So that means the rest of the world is going to be pushing the value. And since there's and then it goes to BRICS, since there's this big push on an international level to de-dollarize, especially that coming up, be prepared, July the 6th, BRICS next big meeting. This is a situation that can drive crypto and altcoins really up higher. The next piece, and this is really significant. Okay, bond yields, the T-bond yields, the 10-year T-bill has dropped from 4.7% to 4.3% since January. That's a huge drop. That's 4 points, 0.4% drop in 5 months, 6 months. That's crazy. Okay. And then the last part is this, and this is kind of a double-edged sword. We've seen generally an increase in income levels for people in the United States. And we've seen over the last year, we've seen a 1.4% increase in income. And you would think that would be great that we've seen an increase in income. But the reality is that's 1.6% less than inflation. So while we see more money coming into our pockets, we also see that everything is so much more expensive that it actually is causing a constriction. We are seeing stretched paychecks, and that's not good for what we do, and not we, me and Jonathan, but what the country does. And so that piece, that contraction of inflation's still up, my income is up, but it's not keeping track with inflation, that reduces the amount of money I have to invest in retirement. And a lot of people are looking at crypto as a retirement vehicle. And it should be probably part of everybody's portfolio, but I think there's some people that are putting all their eggs in one basket, which is never a good thing. What do you think, Jonathan?
I think that you just came full circle on a couple of things that, on a radio, you probably aren't taking notes at home, so I'm going to bring it back. That, we know that Friday we ended with record highs in the S&P.
Yep.
Right. Year to date, we're up 5%. Right. You just mentioned in the last 6 months, U.S. dollars devalued by 6%. 8%. All right. So it's not keeping up with inflation.
Right.
The 5% that we're up, the devalued U.S. dollar, and the T-bond yields dropping. When it's all said and done, what does that do for the average investor? What does that do for the U.S. market, for that individual that wants to get in the S&P 500? Their dollar's worth less, so It looks like they're making 5%, but they lost 8%.
Yep.
They can't keep up with the Fed interest rate, and they end up burying themselves in more and more debt. And when you talked about what we do as an economy, well, we spend when people say spend. And oftentimes we forget to save when it's time to save, because nobody's out there ringing a bell telling you to save, telling you to tuck, telling you to put money in this basket because longevity or because of, this 20-year moving average. So, and it kind of goes to show, with what we do is stability, it's legacy, it's having conversations of certainty. And I know you're not allowed to say that in finance, but when you're talking gambles, you're talking things like participating whole life or annuities, or you have these
shelters.
These shelters that have been in place for a really long time and will be in place for a really long time. It reminds me of an article I read recently, the Lakers, right? Jeannie Buss is talking about selling the Lakers, and there's a $10 billion price tag on that. Well, Jerry Buss bought the Lakers in 1979 for $67.5 million, and now they're evaluated to be a $10 billion entity, which looks like a substantial gains. And there was one person that noted if you just put that money and indexed it into a stable, like you say, bucket, over time, that portfolio would be worth $13 billion now. So
you wouldn't have a huge capital gains issue when you sell.
Exactly.
Right.
Taxes, right? So let's get into that a little bit, because I know what we love to do is we like to look at somebody's legacy, speak certainty to it, ask them questions that really, push that needle forward on an individual level, right? Not a a market level or systemic, let's look at this, let's look at that. We're looking at the individual and saying, what's most important to you? And a lot of times, my average client up in Richmond, I don't know about you down here in Virginia Beach, but in their 50s, 60s, approaching retirement, on that bubble of, I don't want things to pop.
Yep.
I'm nervous for that. Yes, I have fear of missing out. I want to make as much money as I can make, but I also want to get out while the getting's good, because nobody wants to be there when the ball drops. So what do you say to that individual now approaching retirement that sees that it's all sunshine and rainbows? They turn on the news, right, and they're watching their Yahoo Finance, and everybody says that the world is up and up and will continue to be up and up. What do you say to that individual who, maybe has most of their money in real estate or a 401k, and they're nervous about, that ticking time bomb that we all talk about?
First thing, turn the TV off.
Right. Start listening to the radio more.
Start listening to radio more. You get faster news that way. Second, what you see on TV, and if you're watching CNBC or you're watching Bloomberg or any of those other channels that purport to be financial channels, what you see, it's orchestrated, and it was orchestrated. Not that there's a person pulling puppet strings in the background, not that kind of. I'm just saying this. If you think about who actually runs the markets, 10% of the American population owns 90% of the market. So if you're not in the richest 10%, then you're following what they want you to do. You're following the puppet masters, that 10%. And I'm not trying to be conspiratorial, and this is not that's just reality. 90% of equities available in the U.S. markets are owned by 10% of the population. So that being said, if you're not one of those people, then you're not going to be in a position to actually do anything other than try to capitalize somewhat, play it safe. And that's what, Jonathan and I, we practice very safe, conservative programs. I can honestly tell you I've never lost a client money, because I won't put a client in a position to lose money. And that's something, I know you're the same way, because we practice the same disciplines financially. And what I would say as far as what's appropriate, if you are 50 or 55 years old and you're thinking about retiring in the next 10 to 15 years, let me ask you this question. In 2008, which was the last big drop in the market, how long did it take to recover? And the answer to that question is 6 years. So if the market dropped and then it took 6 years to return, and that's where your money is now. It's in a 401k in equity positions or a 403b with a capped growth rate. If the market drops and then comes back and it takes 6 years to come back, are you really even in 6 years? And what does that do to your retirement timeline? And the first answer is no, you're not even, because you've lost 18% because of inflation over that period of time. So, and then what else did you lose? Well, if you were in a position that grows regardless of what the market does, like some of the programs that Jonathan and I do, then you're way ahead of the game. Maybe it only makes 5% per year, but that's still 2% better than inflation, and you didn't have to ride it down and then ride it back up for 6 years. So those programs can take different forms, and there's different types of life insurance products that we utilize in some cases that are for that. There's different financial products that we use in some cases for that. But the whole idea is I don't want to be in a position where I have to ride it down. I want to be in a position where I can say whether or not I want to participate with the market in arrears. Did the market go up? Yep. Okay, yeah, I want to play. Did the market go down? Nope. I don't want to play. That's where I want to be. And you can't be that way if you're in a traditional 401k or 403b or a TSP or a KEO or a SEP or a simple IRA or a FERS program or a state retirement program like VRS. You've got exposure components that are beyond your control. And if your program is only making, let's be conservative, if it's only making 6% per year and it's a tax-deferred program, are you really making 6%? You're not. You're going to lose about 20 to 25% of that gain to taxes. And then look at what you gained or lost from inflation. So therefore, your actual realized gain over time is going to be around 1%. And that's scary.
What's the average fee for an advisor in that position? Right.
So if you have an advisor, I can't comment on their income because I don't know their income. But what I can say is if you Google it, Google's going to tell you the average fee for a financially managed account is going to be about 3.2%. Now, that doesn't mean you're going to see a line item that shows 3.2%, but where are they putting the money? What programs are offering them a commission or a kickback, or not a kickback, but legal stuff? What are they doing? Where's the money going? And if they were doing that with your money, why isn't it coming to you? And do they get paid whether you make money or not? And these are questions that most financial advisors try to scurry around, and they're going to be worried about when you start asking these questions. And if they're a good salesperson, they'll talk you out of making any decision other than what they want you to do, which is to leave the money under their management, because rightly so, they feel like they can do a good job for you, and most of them can. But there's other ways. For me, I don't like having people in risk positions. I know how long it takes for a real market correction to come back. And most people, if you're, like I said, 50 to 55 years old, you do not have the luxury of time on your side. And what do you have now? I'd much rather have a reasonable growth that's guaranteed over the next 10 or 12 years than a potential growth that can also be a potential massive loss. And then I have to work 4 or 5 more years longer than I wanted to. And that's, what do you think, Dally?
Well, I like, as you lay it out, you keep the numbers that are on the top page, the first couple pages, you keep them in the forefront, which is important. But there's also a lot that we do on the back end of legacy that kind of gets lost in this tit for tat conversation between, I'd separate finances in 2 categories, right? You have the bank side, your 401ks, your 403bs, even your traditional IRAs and everything. And then you have the insurance side, your fixed indexed annuities, your IULs, and those, protected from volatility buckets, as I call them. But you enter into one of these programs that we, will walk a client through. Too often we forget to talk about dollar duplication, right? We talk about tax savings. We talk about, fees that you'll save. We talk about long-term, like you say, conservative growth, that stability to know that the money that you've earned up to this point, Mr. 55-year-old, is safe. It's like, that game show, Who Wants to Be a Millionaire? Right. You've made it. We're going to lock that in, and we're going to move on from there, which is not only provides quality of life in that sense of reassurance, but you're no longer watching the news every week to see whether or not you could retire next week. I have so many people that come to me with these, their arms crossed and these questions of, well, why would I roll it into an annuity? Someone told me fees. Well, if you Google the highest fees in any market, 3 out of the top 5 are financial advisor fees, and they're making money off your money even if you're not. But it's that dollar duplication that really has me, chomping at the bit, because we talk about legacy and longevity, and then you have this 55-year-old that comes to, the conversation with their arms crossed and says, well, I've been making 11% in the S&P. Great, how much are you paying in a fee? What? They didn't say anything about fees. All right, how much are you paying in taxes? Well, I haven't paid any taxes yet. Okay, well, what are you passing to your heirs, your beneficiaries? Well, whatever's in my account. Well, how much are you spending in retirement? Because you can't spend it in retirement, pass it to your beneficiary. Oh, wait, you can, and there are products for that we talk about. We educate individuals of your dollar here is worth $2 there, so let's do that. And once your $2 is there, let's make it $4 over the next 5-10 years. Let's do that. Right. So that added variable of, what I love about this industry and what's made me really passionate about it, because getting into it, I wasn't, right? And this, I'm very notorious for being a skeptic. I wasn't passionate about insurance and getting into it. But what I love about it is when you talk about that legacy piece, that, well, we're going to put your money here and it's all automatically worth twice as much. And everybody I talk to, almost everybody, I'll use a made-up statistic, 98% of people that I talk to have families, and they're looking for passing
it's 98.2, isn't it, though?
Right, yeah. Well, I knew it changed. It's not in real time, but they have families, and their concern not only is for themselves, but what am I leaving behind? What can I leave to my beneficiary, my successor, and The one thing I ask them all, the two questions I ask everybody is, it happens too fast. Because us with kids know that in a blink it's gone.
Yep.
They're kids, then they're arguing with you, and all of a sudden they're college, and now they're out the door, now they're grown, and then they don't contact you. This is the whole story, right? So everybody agrees on two things. One, it happens too quick, and then the second
like a
one.
Cat Stevens song. I'm just saying.
I'm not writing
Cats in the
lyrics, and we're
Cradle.
not giving individual
Right on.
advice, but if you want to take the lyrics and use it, my email is jonathan@thedallygroup.com. So, and the other question I ask everybody is, you're not promised tomorrow. And I know that we all agree on it. You're not promised tomorrow. So if I could put your money in a place where tomorrow, whether you're here or not, your family, benefits doubly so, then it's a no-brainer for a lot of people that approach that conversation of, I want my money and I want to eat it too. So, that really drives my passion of that. When we get in this, what we called in football when I was coaching at the college level, it's the last person with the grease pen wins. Yep. When you're back and forth with, if I do this, then you do this, and I do this, and we get, this bickering constantly with this other side of the table, this U.S. market, this S&P 500, this, rocket growth. It's, at the end of the day, what's the most important thing? Well, I want to have my money. I want to have access to my money. And what's the next important thing? Well, I want to leave some money. And, when you cross over to that field of volatility, I love this because you mentioned cryptocurrency, and crypto almost has this stigma in the name. It's almost built right into crypto. People are like, I don't know it, I don't like it. But we talk about making big money and big risk, and we talk about the gamble that is risk versus reward. And, when you go from life insurance, you reduce that risk to zero. Like you said, I never put my clients in a financial position where they can lose. And then you move to the S&P 500 where the volatility increases. And then you move to crypto where the volatility increases. But you have more that shows an upside in crypto and what we do than anywhere else. And I love that.
Right. So here's a big question, Jolly. If you have a $250,000 tax bill, how much of that tax bill do you have to pay? Or is there a way you can reduce that $250,000 tax bill down to, less than $5,000? The answer in 30 seconds, or however long it takes, Lee.
All right. 757-278-1264 is the number at the Forehand Agency. If you want to call them and speak to them in the Hampton Roads area, 757-278-1264, or outside of Hampton Roads, 1-800-677-0989. Also visit them online. forehandagency.com is that website. And don't miss Scott's class coming up on this Thursday, July 3rd at 5:30 p.m. We're back right after this on News Talk 790 WNIS. And here's Scott Forehand.
Mr. Foster, my wife just sent me a text. We moved, and we live in Edenton, North Carolina now, and we have this ritual on Saturday mornings that we go to the local farmers market. And in the farmers market, they have this wonderful, she used to be a pastry chef at the Albemarle Plantation Country Club, and she's phenomenal. And she makes friendship bread. And that was the big joke at our house a couple of weeks ago when we had a bunch of guests over. We were going to go down get some friendship bread in the North Carolina tone accent. And Donna just went and got some friendship bread. So it's pretty exciting.
Good.
So the thing we said before the break, we were talking about taxes and is there a way that you can reduce or eliminate taxes? And the answer is absolutely yes. And there's a tool that we use, and it's not right for everybody, but it does involve a 501c3. And I just did this for one of my clients. He had a $270,000 tax bill because he sold a piece of property that was a rental property. And so we did this maneuver with this 501c3, and we were able to create a situation for him where his total out-of-pocket was not $270,000. It was only $66,000. So we saved him $204,000 in taxes, which he then turned right around and invested it, just like he should have. So there's all kinds of tools that are out there, folks. The IRS tax code is over 3,000 pages long. There's no one person who knows all of it, and there's bits and pieces that are known by a lot of people, and we know a lot of it, and that is part of our planning process when we look at taxes and retirement. It's not about how much you make; it's about how much you keep. And some of the tools that we utilize, Mr. Daly, are designed to help us keep more because of the tax-exempt nature of their distributions. Tell me about that.
Yeah, so I like how, well, I don't like how all too often we have this conversation with somebody who's, experienced 270,000 in capital gains before they find out they can save in taxes, right? We want to help you save in taxes when you're in your 20s and 30s and 40s so that by the time you're in retirement, you can kind of laugh at all the people paying taxes.
Yeah.
But there are ways to maneuver. Like you say, it's that insider look. It's that Tony Romo calling the game. Who do you want as your financial professional? Do you want that person who can scramble and show you everything you need to do in that first conversation? Absolutely. You want somebody who has their finger on the pulse, who knows exactly where you are financially, what your ambitions are and your goals are. And nobody wants to pay more money to Uncle Sam than they have to. And we're set in an industry not only conserve the long-term growth, but pay less taxes,
yep.
which rings true to everybody. It's another thing I love, offering clients
right.
is that, hey, you have that CPA that says, I'll save you $100,000. You only have to pay me $80,000.
Right.
Right. Well, in our business, we don't take that.
Yeah.
We're not creating that invoice. We just save you for the sake of saving
yeah.
you. And then, hope that you pay it forward. Like you say, invest it, make more money with it. And if we can help you put it in a vehicle that's going to make it last forever, then so be it.
I have a quick question for you. This is a math question, Jonathan. Okay. All right. If you make $200,000 and it's all taxable, okay, or you make $160,000 and none of it's taxable, which one's better?
The latter.
Right.
Yeah.
How much better?
No taxable better.
Yeah, a whole lot better.
Yeah, exactly.
Right?
Whatever that percentage was.
It's certainly double-digit better.
That's more of a philosophy question, though. I didn't have to do any number crunching on that one. I love it.
But that's what a lot of our clients deal with. They don't understand, and they were told, they were fed that line for the longest time. Invest in your 401k, put as much money as you can, and when you get older, start doubling up and tripling up and put more money in there. And I keep saying, why? Why would you put more money into your 401k when you know you're actually increasing your tax exposure by doing that? Why would you put more money in your 401k knowing you could lose it? Why would you put more money in your 401k when it has zero guarantees? And that's where most people miss the boat. It's that you need to have a diversified portfolio. And when I mean by diversified, I don't mean have money in 15 different stocks. I mean diversified. Real estate, private pension income annuities, maybe an IUL, maybe an infinite bank, maybe participating whole life. There's all kinds of stuff that's out there, and you should have a little bit of all of it. The last thing what anybody should do is have all their eggs in one basket, and unfortunately that's what a lot of people do. Jonathan, I'll give you the last word.
Yeah, so to that point, you have the average American as an investor that's, pouring money into a 401k. Stop doing that. Get a hold of somebody who knows what they're doing.
There you go.
Scott.